Hello guys and welcome back. This is going to be episode number 3 or lesson number 3 on inducements and traps. We understand liquidity. Now we're going to start touching into other confluences we use, example being inducements and or traps. Let's hop right in. So introducing inducements. Okay, there's a lot of fluff around this word in this industry. I'm going to keep it as simple as possible for you guys. In trading, inducements are moves that create the market to lure traders into the wrong direction. At first glance, they may look like legitimate breakouts, trend shifts, or structural moves, but their real purpose is not to continue in the apparent direction. Instead, inducements are designed to generate liquidity. When the market doesn't have enough orders to move where it truly wants, it creates these moves to encourage traders to enter positions, providing the fuel it needs for the next significant move. So guys, basically the inducements we see, whether that's a move higher, naturally that induces some type of trader to do something, okay? When we have a move higher, maybe it'll entice buyers to be more present in the market, okay? And if we have a move lower, you got to think about the why. What does that move lower do? It might induce sellers, right? We've had this big momentum move to the downside. Sellers want to be present in the market. Okay, so these are things you have to ask yourself. These are things you have to be aware of. So the textbook definition, and again, just like I said before, I want to keep this as simple as possible for you guys. To understand inducements more clearly, let's start with the dictionary definition. Listen closely. An inducement is something that persuades, encourages, or motivates someone to act. It refers to an action, benefit, or influence that leads a person to make a decision. It is neutral in itself. It does not guarantee a good outcome for the person being influenced. Its power lies in the ability to create action. In trading, the principle is exactly the same. The market induces traders to act, presenting moves that appear legitimate or promising. But unlike ordinary decision making, the market does not care about individual success. Its goal is entirely different. The market seeks to access liquidity. Every inducement is designed to create a situation where traders commit capital and define risk, which results in stop losses, orders clustering in predictable areas. In the context of trading, inducements becomes the tool that market uses to manipulate participants. Traders are motivated to enter, react, or commit capital, and in doing so, they unknowingly supply the fuel that the market needs to execute the real move. Understanding this connection transforms the way you interpret price action. You begin to see that behind every convincing move, there is an intentional push to generate liquidity. Simply put, inducements in trading are not random or harmless. They are calculated moves that use trader behavior as the source of energy for the market's next major directional action. Okay? Inducements in practice. In practice, inducements take many forms. They can appear as small breaks of structure, false retests, short-term trend shifts, or any move that appears to offer a genuine opportunity to the trader. What makes them so effective is that they are convincing, okay? Very important, guys. They mimic legitimate market behavior closely enough that traders trust them and act on them. Traders may enter in early, thinking they are ahead of the move. Others may enter late, chasing momentum. Some may even enter in the wrong direction, misreading the underlying trend. Regardless of timing or direction, the result is the same. Stops and risk are defined in predictable areas around these moves. Okay, so these inducements are done on purpose, guys. Very important. These stops are not just points on a chart. They represent actual liquidity. Real money waiting to be accessed. Once enough traders are induced into taking these positions, the market has created the fuel it needs to execute its next meaningful move. So that's why sometimes you see like a big move to the upside, inducing buyers, and then all of a sudden the market collapses down. Those are the moves we look to catch, okay? This is why price often appears to trap traders. The initial move is not meant to sustain itself, but to generate participation. Example being, we have a move to the upside. We're inducing buyers to enter the market, okay? Generating liquidity to the downside, and then we get that sell-off back down. Okay, so now on to our first example we have here. So we have a retail POI, which we've covered in previous lessons, okay? The market reacts off it, perfect. To the downside we go, taking out a structural point. Now look what I have marked out for you guys here. BOS, break a structure, sellers induce. This is what I want you guys focusing on, okay? Sellers are induced. Why are they induced? Because this move from high to low has taken out all of these lows here, okay? Now, naturally, the common trader, the common retail trader is going to view that to have momentum to the downside, right? So look how when the market trades back up to the highs, we get reactions here. Why do we get reactions? Because this move, understand this, from high to low induces sellers, okay? Now check this out. We get another retail POI in this area. Look how the market reacts. Sells off to the downside from high to low, taking out lows here, right? What does that do? Induces sellers into the market. Look at this again. High, this is the same thing, just on a bigger perspective. And then on a smaller perspective, same thing. These moves induce sellers, induce sellers, induce sellers. Finally, we get that move back up to the upside. Okay, so we have more examples here. Again, look at this sell off to the downside we had, taking out lows here and lows here. This is a BOS, okay? Sellers are induced in this example, okay? So red boxes, areas we understand sellers want to be entering from. Being up here, maybe we have a refined area up here. Another reaction. Look at this. Okay, I'm going to circle all these from high to low. Sellers induced, okay? From high to low. Taking out lows. Sellers are induced. Same thing here. First we have from high to low. Taking out lows. Sellers induced. Every single time we induce sellers, we are engineering liquidity to the upside, guys. Okay, I hope you guys are starting to see us starting to piece this together. Now, why do inducements exist? The real inducements exist is simple, yet fundamentally to understand how the market operates. Okay, the market needs liquidity to move. We all know this by now. Okay, we've been covering this in the last couple lessons. Price cannot simply continue in any direction on its own. It requires fuel. And that fuel comes in the form of money committed by traders. When there aren't enough resting orders or positions in the market to support a strong, sustained move, the market must create a situation where liquidity becomes available. This is where inducements come into play. Once enough liquidity has been accumulated through these inducements, the market can release it to fuel the real move. Price can then expand decisively, efficiently, and often in the opposite direction of the initial inducement, leaving many traders caught on the wrong side. Without inducements, the market would struggle to access sufficient liquidity to sustain significant directional movement, making these trick moves an essential component of market mechanics. Understanding this changes the way you interpret price action. What may look like random reversals, false breakouts, or sudden retracements are not mistakes. They are deliberate mechanisms the market uses to gather fuel before making its true move. Recognizing inducements allows you to see the market as a system that collects, stores, and uses liquidity purposefully, rather than a chaotic collection of ups and downs. Now, connecting inducements to traps, okay? Now we're going to start piecing together the trap side of things. Inducements and traps are inseparable. They are two sides, and I'm going to circle this for you guys, inseparable. They are two sides of the same coin, and one cannot exist without the other. An inducement occurs first. The market creates a move that persuades traders to enter positions in a way that appears legitimate, okay? Appears legitimate. Remember that. Traders respond, placing stop losses and committing capital in the predictable areas. This is the setup. The stage is being prepared. The trap follows naturally. Once enough liquidity has accumulated from induced traders, okay? Let me circle this for you guys. Enough liquidity has accumulated from induced traders. The market revisits these key levels and triggers the stop losses. Traders find themselves caught on the wrong side of the market, their positions exploited to provide the fuel the market needs for its next decisive action. The trap is not accidental. It is the execution of the plan that the inducements began. Understanding this dynamic is critical for reading price behavior correctly. Every false breakout, retracement, or short-term reversal can now be viewed as a part of a larger intentional process. Price is not simply moving randomly or testing extremes. It is methodically gathering liquidity through inducements and then traps to release it. Recognizing this pattern allows you to stop reacting emotionally to market noise and instead see the underlying purpose behind every move. When you get to a point in your trading journey, when you start viewing the market like this, you'll understand and you'll view the market a lot differently. Okay, and you'll start to look at the charts and you'll be like, wow, okay, I understand why this move happened now. Now, very important. I'm not telling you guys I want you guys trading every single move because that is completely unrealistic and that is completely unprofessional. Now, yes, you can make sense of why these moves occur, but that's completely different to how you trade overall. Okay, how you execute overall. I don't want you participating in every move. However, you can now understand why these moves actually occur. So let's say a sell move occurred. You're not trading that sell move. You're focusing on that buy move back up. Okay, you understand why the sell happened, but you're just participating in that buy back to the upside. Okay, in essence, inducements create participation, traps capture liquidity, and together they power the market's true directional intent. The better you understand this relationship, the more clearly you can anticipate where liquidity lies and how price is likely to behave in response. So now we're going to see some traps in action, okay? Just some people like to call them traps. Some people like to call them liquidity grabs, false moves, whatever you want to title them. We're going to talk about all this right now. So traps occur when traders are caught on the wrong side of a move, usually after being induced, okay? So again, very simple way of summarizing what we just said there is sellers get induced, a move happens to the upside, sellers trapped. Boom, very simple. They may have entered thinking a trend would continue or that a breakout was real, only for a price to reverse it and take their stops. The market then has the liquidity it needs to fuel the real move. Observing these traps repeatedly allows traders to recognize the underlying purpose behind seemingly random market behavior. So we have a chart example here on the right-hand side, this diagram. Okay, now we see that this sell move, just like we were talking about in the previous examples, induces sellers because we take out this low here. Okay, this high volume move to the downside takes out a low. There's a BOS for retail. So sellers are induced. Now look at the move that happens to the upside. Big move from low to high, trapping the sellers. Okay, so look, the market is moving to the upside. Sellers are induced due to the bearish BOS, and that high led to the BOS is now a trap back up to the upside. Okay, it's actually very simple and it's very straightforward. All right, but now we're understanding the why behind these moves. Okay, the sell move happens to induce sellers, and then the bull move happens to trap them. So here we have some chart examples right in front of us. Perfect. Highs taken out, highs taken out, and highs taken out. Every single time we do that, look what we've written down here for you guys. Buyers are induced. We now have this sell off to the downside, high to low, inducing sellers. But what has this sell move done to the downside? Since buyers were induced here, this sell move all the way down has now trapped those buyers. But not only have we trapped buyers, we have induced sellers, which tells us we want to participate in that move back up to the upside. And look, we've simply marked on, look at this, X equals trap. These red areas are all traps. Reaction here, trap. Any reactions here, trap. We have more here, it's a trap. And that's how we're able to establish who's induced and who's going to be getting trapped. Here we have more traps in action to train those eyes as much as possible. All these red areas, traps. Okay, look how we have a move to the up, or we have a move to the downside, I should say, from high to low, inducing sellers. They get trapped. Another one here, just focus on this. This is the only thing I want you focusing on here is the traps. Look, we induce sellers by taking out this low. There's that BOS for sellers. And then we trap them. Look how there's even another reaction here. Inducing sellers once we take out this low right here. And then we trap them. And here we have more examples here. Sellers are induced. Perfect. Red areas are traps. Okay, so hopefully you guys are starting to see the same thing over and over here, right? Again, sellers are induced in the market, meaning we want to buy, of course, but we want to understand where sellers are being induced and why. But again, since sellers are induced, we have liquidity building here and here. Look how we get reactions here for so long. Look at this price action, guys. Let's zoom in to this area, okay? Because we've marked on a lot more inducements here. Took out a low, inducing sellers. We took out a low, inducing sellers. Took out a low, inducing sellers. Took out another low, inducing sellers. And then finally on the lower time frames in here, we take out a low and we induce sellers once again. The more you understand this, and once we get into the later lessons on entries, you'll soon realize that all of these areas, these are entry opportunities, okay? The market has simply presented over 1, 2, 3, 4 different opportunities to buy this market back up. However, do we need to participate in all of them? Hell no. That's not what we're here to do. We just want to catch a piece of the puzzle. We just want to catch a piece of the move. That's it. So yes, you can enter all of them if you really want to. I'm not recommending it, but you can see in this example here, there is multiple opportunities. So why does this matter? Recognizing inducements and traps fundamentally change how you view the market. Instead of asking whether a breakout or retracement is real, you begin asking where liquidity exists and whether traders are being lured into it. This perspective shifts your focus from predicting direction to understanding the flow of money, giving you a much clearer framework for observing price action. All right, guys, now we have concluded lesson 3 on inducements and traps. Now you're starting to see how and why we use these concepts, okay? It's basically the why behind these moves, right? We've talked about liquidity, we've talked about now inducements and traps, and you can see how we're now starting to piece it together, right? We're understanding who these sell moves are inducing, who these buy moves are inducing, right? Big move down, inducing sellers. Big move up, inducing buyers, right? There's a reason. And again, we're going to be putting all these concepts together in future lessons. But again, that concludes lesson number 3.